Hi there, folks. Sean Burdick. I'm in West Palm Beach, and I'm speaking to Kyle Preston. He is the Director of Investor Relations for Vermilion Energy. Now, they are a great global oil company based in Canada, but they operate around the world. And they have a nice dividend, which I'll show you in a chart. And they are doing great things with that dividend, doing great things with their production, doing great things with oil and gas. He's going to give you the scoop. Could you please speak to my subscribers about what your company is doing right now?
Sure. Thanks, Sean, and thanks for that introduction. So, Vermilion Energy, we are a Canadian-based but globally focused oil and gas company. Our business model is really focused on growth and income. We are just over 100,000 barrels a day. We have production in Canada, the U.S., and all throughout Europe, France, Netherlands, Germany, Ireland, Eastern Europe, as well as an oil project down in Australia. And again, our focus at Vermilion is to try to deliver our shareholders modest production growth, 5 to 7% production per share growth, while paying a very sustainable dividend. We've been paying a dividend for 15 years. We've never cut the dividend. We've increased it on 3 occasions. We are currently paying the equivalent of 23 cents per share per month. We are listed on the Toronto and the New York Stock Exchange, but at the current share price implies a yield of around 8.5%.
Now, speaking about that dividend, even during the dark days of like 2016, when the oil price was like falling through the floor, your company did not cut its dividend, even though many of other companies did, right?
That's right, Sean. I mean, I believe it was February of 2016, oil prices traded down to around $27 per barrel, and the big advantage we have in our company is we have a lot of flexibility in our capital program, right? So we have assets all around the world. They all have different commodity price exposure. So, at that time when oil prices were hit really hard, I mean, we were still generating very strong return on our European assets. So, we had the flexibility where we could cut capital in the areas that weren't generating a strong return and allocate more capital to these higher return projects, which again provides us that flexibility where we can manage that dividend through the various commodity cycles.
Flexibility and consistency, which are two things we like. Another thing that I found interesting is that your company, even though you're in Canada, you aren't in heavy oil, which during this last year, which was really kind of tough for the heavy oil companies, that gave you a real pricing advantage, isn't that right? Yeah,
I mean, in Canada, we have basically two main areas that we're focused on. We've got a light oil production in southeast Saskatchewan. For those of you that are familiar with Canada and the provinces in Canada, most of the oil production in Canada comes out of Alberta and Saskatchewan. Where we produce in Saskatchewan, it's a light oil. It's downstream from all the pipeline curtailments. So we typically see fairly stable pricing there. It typically trades at a $5 to $6 discount off the WTI. Where a lot of the issues in Canada are today is in the heavy oil being produced out of the oil sands in northern Alberta.
Yeah.
With that growing production base, they're competing in Alberta to get access to a pipeline. Most of our oil in Saskatchewan is shipped on oil-dedicated pipelines, and most of it gets shipped down to the U.S. To be refined in the refineries there or in eastern Canada. So again, we tend to have a pricing advantage on our light oil in Saskatchewan, and most of the production that we have in Alberta is also an advantage product. It's mostly condensate that we are focused on there, and condensate is a product that they use in the oil sands to blend with the bitumen that they produce there. So
right, because that heavy oil needs to be
correct,
cut, so it can be
correct. So it's in short supply. So typically trades at a very strong price in Western Canada.
Okay, let's switch to Europe a bit, because you guys have an exciting new field there. And also, I did want to mention, even though natural gas prices are low here in the U.S., over in Europe they're quite high. And since these guys produce a lot of natural gas in Europe, it gives them another price advantage. Could you speak to those two things?
Yeah, so the European market is really, the gas price there really trades off of the global LNG market. The oil prices in Europe today are around $9 to $10 Canadian per MCF. You compare that to Canada, which is well below $2 an MCF, so it's a big advantage that we have. We produce around 32 to 33,000 BOE a day in Europe. Most of that is gas, so we are getting this premium European gas price. And Sean had alluded to a couple of new projects that we have there. Most of these countries where we have assets, we still have a lot of growth potential. Netherlands, we are ramping up our drilling program there. We see a lot of growth potential in the Netherlands. Eastern Europe, we've got a few, actually quite a few new projects that we're pursuing this year. It's a 10-well program versus the very first. We drilled 1 well last year, our very first well in that region, but approximately 2.8 million acres of land gives us a lot of running room in that region. And again, you get the high European gas price, or if it's oil you're producing, you're getting that Brent oil.
Okay, so your company has flexibility, consistency in the dividend. You have exposure to the high prices in the European market, and you are well positioned in North America as well.
I think our track record as a producer. A big focus on ESG and sustainability.
Right.
Which
is very important over in Europe.
It's very important in Europe and becoming more and more important to all investors around the world. Right. We are a very responsible developer. We take this view that we support the energy transition. The world over time is moving towards more and more renewable energy, but that's going to take time, likely decades and decades. There's still a lot of oil and gas that's going to be produced in the world over that time period. And, we encourage investors to invest in companies that are responsible developers. And, Vermilion definitely hits that mark.
Okay, great. That all sounds really good. We'll take a closer look at this company. Is there anything you'd like to add before we go?
You know what? I think we provided a really good summary there.
Let's give them the stock symbol.
Stock symbol is VET. Again, on both the Toronto and the New York Stock Exchange, exact same symbol, VET. As I mentioned in my earlier remarks, currently paying a monthly dividend of 23 cents Canadian equivalent. You'll get the US equivalent based on what the prevailing exchange rate is at that time, but implies about an 8.5% yield today. So if you look at our investor material, you'll see that dividend is fully sustainable in the current commodity price environment. And as we talked about earlier, a lot of flexibility there within the capital program to make sure that we can protect and continue paying that dividend.
Excellent. Okay.
All right.
Thanks for speaking to my viewers.
Sean.
You folks stay tuned. This is Sean Broderick in West Palm Beach, but I find out the deals for you everywhere. You guys stay tuned for more.